My name's Joe Sable. I'm in investor relations. I've been with the company not quite from the beginning, but almost. I was employee number 19. Now we're up over 100. I've been here over 4 years, and we've grown from a small company to a company now with over $250 million in investment capital, and I think we're on our way towards $1 billion or more. So Yrefy is in the business of working with private distressed student loans. Now, let me talk a little bit and give a little bit of background about the student loan market out there. Most people don't realize that there are two types of student loans. There's federal loans, and then there's private student loans. Federal student loans are something like $1.5 trillion. Private student loans are a couple hundred million, or I'm sorry, a couple hundred billion. Both of those combined are bigger than credit card debt in this country, bigger than auto loan debt, and it even is larger, that value, than the size of Canada's annual GDP. Student loans are an enormous problem and an enormous asset class in this country. How student loans typically work is a child goes to college, they fill out what's called a FAFSA form, and this form gives that family an indication of how much federal student loans they will qualify for. Once they use up all of those federal student loan credits, essentially, and the child wants to go to graduate school or any type of secondary education, they usually have to go to the private student loan market because they don't qualify for federal student loans. Private student loans then come in, and these are loans from Bank of America, Wells Fargo, Navient, SoFi, all of the other lenders out there in the world that you know about that are not part of the US government. We don't talk about it much anymore, but the reason I go into this in depth like this is because in the prior administration, there was constantly a talk of student loan forgiveness. And people would get confused and think that private student loans could also be forgiven. That's absolutely not the case because private student loans are not a government asset. Those are only federal student loans. So just to close up, private student loans, the space that we play in, are not part of the government portfolio. They're not a government asset. They're a private asset. They are also subject to what we call bankruptcy remote, which means borrowers generally cannot get out of their private student loan debt if they go through bankruptcy. Just to give you some more facts on the student loan market out there, in 2008, it was less than $1 trillion in total value. In 2017, when this company was started, the distressed private student loan market by itself was $21 billion. Most private student loans are variable rate products, which means over the last few years, as interest rates, as we know, have skyrocketed, the debt burden, the interest burden on the private student loans have doubled, tripled, and in some cases even quadrupled, which has led to private student loans having distressed private student loans being more north of $45 billion and continuing to grow at just crazy levels. So as I mentioned before, there are two types of federal student loans. They're both bankruptcy protected. They're called bankruptcy remote. On the federal side, if a borrower gets into trouble, there are all types of ways that the federal government can work with them. But the federal government can also do some things that can be quite painful. They can garnish your wages, they can take your Social Security benefits away, they can take tax refunds, and they can even suspend professional licenses, which doesn't make a whole lot of sense, in my opinion, because how can those people work if they don't have some of their licenses? On the private side, borrowers get hit with late fees, and if they are delinquent for long enough, they can take and move that interest rate up even higher, hit them with collection costs and attorney's fees. And these private individuals are looking at interest rates that are right up against the maximum usurious interest rate that state allows. It could be in the mid-20s, it could be in the 30s. It's a very slippery slope. When somebody goes down this route, they're very likely not going to come out from it. And with that problem in mind, there was really no solution for these borrowers. Our founder, Don Fenstermaker, 8 years ago, came up with this solution and said, hey, we need to help people. And the solution is we work with borrowers one at a time. We're the only people in the country that are doing this. We work with borrowers one at a time. We don't buy portfolios of loans. We don't buy pools of loans. Our borrowers, our prospective borrowers, actually call us. They seek us out. We market to them, and we put them through a rigorous underwriting process that on average lasts about 6 months. During that time, we're underwriting these individuals like they're getting a new mortgage. We collect pay stubs and tax returns. If they don't have a co-borrower, we try to put a co-borrower on the loan. About 75% of our portfolio has a co-borrower. But more importantly, during this time period, the prospective borrower is escrowing to us every month the new lower prospective payment that we think they can afford. And it's this way that we essentially find borrowers that not only want to get out of the problem, but more importantly, have the ability and the follow through to make a payment stream that shows that they can actually afford our loans. And during this 6 month time period, while we're collecting these monthly escrow period payments, we're negotiating in the background with whoever owns their loan, bank, the collection agency, the law firm. And what we're doing is we're settling that loan at a steep discount, somewhere around 38 to 40 cents on the dollar. But yet we turn around and collect the full value from our borrower. Now, some people ask, you're getting it at a discount. Why don't you cut the borrower a break and maybe only collect half of it or 3/4 of it? And the answer is we could actually do that for the borrowers. The problem is, and the reason we don't, is because if we did that, the borrower then gets hit with cancellation of debt income tax. And these people don't have $10,000, $20,000, $30,000 lying around to pay an income tax bill on this debt that we cut for them. So we share the discount with them in the form of a very low fixed interest rate. Our average interest rate in our portfolio is 3.8%. These are not predatory loans of any stretch of the imagination. These are actually some of the lowest loan rates that you could get out there. Our maximum interest rate is only 5.2%. We have some interest rates out there in the 1% and the 2% range. And all we're trying to do is make that payment affordable. We completely customize every single loan based on that borrower's ability to pay. Then now that we have these people, we put them in a portfolio, and this is called Student Loan Portfolio 4. It's our fourth portfolio. It's an open-ended portfolio. We really like the opportunity here. Our investors really love the ability to create their own custom ladder and fixed income stream. And so what we allow for our investors to do is they can pick which investment they would like. They can mix and match and do any combination of our 5 different maturities. There's a $50,000 minimum, and you could put 10,000 in each of them if you like. You could put 25,000 in the 1 year, you could put 25,000 in the 5 year, or you could put all 50,000 in the 5 year. It's entirely up to whatever the investor would like to do. We pay interest on a monthly basis, but yet if a person doesn't need all of the income, or if their situation changes down the road, you have the ability to compound any portion of this investment. I've never seen anything like that in the fixed income world before. You can compound half of it and receive half the income, and then the rest of it will grow at a daily compounding rate. So you're going to get higher than a 10.25% fixed return. You can do that in each of the separate tranches. You can compound them at different rates, and you can change that election as often as monthly. I have clients that compound the entire amount of their 5-year note, except during 1 month, they receive the income to pay their property taxes. You can do exactly that with our product. You can also say, hey, you know what? This Yrefy thing sounds really great. I just kind of want to try it out. You can go into the 1-year note and earn 6.5%. And right now, I think that's a terrific money market replacement vehicle. And at the end of that 1 year, you can say, yep, I think this thing worked out great. And you can then roll into one of the other higher earning longer maturities. And why does that matter? Let's say you go into the 2 year. You've completed the 1 year, now you're halfway through the second year, and something happens. So you need some portion or all of the money back. We allow clients to get their money back with no penalty on the interest. We call it a redemption feature. You can redeem your money at any time. We pay it back to you within 10 days. There is a clawback of the accrued interest in the term that you haven't completed. Since you completed the 1 year in this example, all of that interest is considered ensconced, it's earned, it's yours. During the second year, if you require any of your funds back, the penalty only applies in that second year. The penalty is very simple. The longer you're in our product, the lower the penalty on the accrued interest. If you're in the 5 year for 2.5 years, you're in it for 50% of the time. The accrued penalty is 50% of the accrued interest. If you're in the 5 year note for 4 years, you completed 80% of the time, the penalty is only 20% of the accrued interest. We think that is, a reasonably fair way to encourage people to stay in our notes and encourage you to stay in the longer notes, and that allows us to pay a higher fixed return on that 5 year product. I have a little video. These are all over Investors Row. You're welcome to watch them there. We have testimonial videos like this all over the place. We do all of these in person, and I think you can get a better sense, honestly, in a 3-minute video from what we do and how life-changing our product is for the borrowers out there and what a difference it can make in their life.
I finished my education in the summer of 2020 in financial accounting. I got some government loans and not even enough to cover my schooling, so I had no choice but to go and get private loans. I didn't know there was even a difference between government and private loans, and I don't think that my mom knew either. I'm the first one in my family to go to college, like a university. Altogether, I think I had about $80,000 in debt from a bachelor's degree. I remember I picked up the phone, I tried to explain the situation at hand. It wasn't listened to or cared for. I felt like I was kind of talking to a robot, and they just kept demanding money. I had every intention of paying my debt. I just needed time to get ready and to get the money so that way I could actually pay it off. And that wasn't an option until I found you guys. Rose was the first person I talked to on the phone. He was so kind. I feel like when I first started doing all this, it was just, special situations happen. We're all human beings and we can't control what happens in our lives or our parents and our support systems, and nobody listened. But Rose was so just validating and patient. I think that set it apart from so many other places, was that, I got to be hands off and just breathe, All I had to do was give you my information, and then the solutions, happened. I got a notification actually from my credit agency that there's been a change, and it was because I don't have a loan in default, and the excitement when I called my mom and told her, she doesn't have any more loans in default anymore, My biggest dream is to have some sort of foundation or something, a group to help, underprivileged kids. And trust me, anytime I meet anybody, this is going to be the resource that I refer them to.
And I like to tell people that I work with that your investment dollars are going to help people like Valerie. We've got 14 or 1,500 of them across the country. Half of our borrowers are teachers and nurses. And when you think about it, it makes a lot of sense that they would be people that would need something like us to help them. They all require graduate level education. They have good jobs, but not great jobs. And as Valerie said, and I can say things like this have happened to me too. Everybody in life hits a speed bump at some point going through life. And we're looking for people that, want to grab a hold of a lifeline, want to work with somebody like us, and want to fix this problem. And people like Valerie, or who we're reaching out to, or who are reaching out to us every single day, and appreciate what we do for them. And she talked about her credit. We didn't get into this business to fix people's credit, but what we found is that their credit jumps about 125 points in the first 9 months of working with us. Most of these people come to us with a 450 or low 500 FICO score. And most people recognize that FICO, unfortunately, kind of drives everything in this world. It affects your auto insurance, affects your ability to rent a house, not only your credit card rates. And so as these people's credit starts to improve, and we report all of those previous escrow payments as back completed payments, and we subtract that escrow from their principal on their very first statement. So the first statement they get from us right out of the gate, their principal goes down on the loan they borrowed for probably the first time in their life. So they're coming out of the gate feeling like, wow, I'm winning. And then they see their credit scores start to rocket higher and their whole life changes. And it's all because we helped them with this student loan. And these people generally don't have homes and a whole lot of other debt. They got into a problem before really life and asset formation could really take place. And we're helping fix that solution for them. These people knew what it was like to be in that financial black hole, and they don't want to go back to that. And that's one of the reasons that we have such a high collection rate, which over the life of the company, our default rate back to us is less than 2%. It's an outstanding level. And, it hovers right around 98%. And when I started, we were somewhere around 20, $25 million when I talked to Ramez. Now we're a company that's closing in on 250 million in investor capital and over 100 employees.
Well,
Yes,
Joe,
sir.
you just said that. Joe, you just said that, and the question just followed up from Jay was, why is your default rate only 2%?
Great question. Let me talk about that in a little bit more detail.
Okay.
So our real secret sauce and what keeps that default rate so low is that escrow period that I talked about. We require all of our borrowers to undergo that escrow period. Now, during that time, they're paying to us the new prospective loan payment that we think they can afford. We have not settled their loan at this point. So what we're doing is essentially weeding out, for lack of a better word, people that aren't going to be able to continue to pay the loan. Everybody could say, yes, I want to fix this problem. It's entirely different to find somebody that actually has the ability and the stick-to-itiveness to keep paying that escrow stream. About half of the people in that escrow stream miss a payment or fall out. And if they're going to fail, that's exactly when we want them to fail, because it's not using any investor or company money at risk. We send them their escrow payment back 100%. We don't keep a dime. And we say, you know what? Why don't you call us back when you're ready? When you and I were first talking, we were doing one investor at a time and one loan at a time. And,
I remember.
it
Joe,
was
I
literally like
remember.
that.
Yeah.
And now we had this kind of machine running where we're honestly raising, it's almost hard to believe, 20 million a month now. We are growing so fast. And I think, in this volatile market, our fixed rates really resonate with investors and people really appreciate what we're doing. I would encourage you, if you have any interest whatsoever, reach out to me, schedule a meeting, give me a call, shoot me an email. I didn't even mention it. We have a handy little simulator on our investor portfolio or investor portal where you can see what the difference in compounding can do to your investment and how that can change things. You don't have to log in. It's at investyrefy.com. It's up in the upper right. You can play around with it. And I would say, hopefully try us out. I recognize we're not a fit for everybody. But if you think it's of interest, I would encourage you to give me a call. We're growing like a weed. We're helping a lot of people, and we would love to have you folks be more of a part of that.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.